Hello friends, welcome to Titiksha Finance. In the world of trading and investing, emotions run high. Greed during booms, fear during crashes. But what if there was a framework to understand these ups and downs with clarity and patience? Today, we explore market cycles through the lens of one of the greatest technical analysts, Martin Pring. Martin Pring is a legendary technical analyst who has written extensively on price patterns, momentum, and market cycles. Markets are seasonal. Your job is not to fight the cycle but to flow with it calmly. This is how real wealth is built, through compounding over multiple cycles. This is not about quick tips. This is about building the Titiksha mindset, patient endurance, so you can navigate markets calmly and make better decisions. He teaches us that markets do not move in straight lines. They move in recurring cycles, just like seasons. Understanding these cycles helps us recognize where we are in the bigger picture. Avoid buying at the top out of excitement. Stay patient during corrections. In Indian markets like Nifty, these cycles have played out repeatedly over decades. Let's break it down into 4 phases. Martin Pring describes a typical market cycle in 4 important phases. Let's explore them together. Phase 1 is accumulation, also known as the bottom or spring phase. This is when smart money quietly buys while most people are feeling fearful. Prices are low and sentiment is very pessimistic. You might notice volume starting to pick up slowly. Have you ever seen a market bottom where everyone was scared, yet that turned out to be a great long-term opportunity? Think about some historical Nifty bottoms after major corrections. That's exactly this phase. Phase 2 is markup or the uptrend phase like summer. Prices begin to rise as fundamentals improve and sentiment becomes positive. Momentum starts building strongly. This is the phase most retail traders love to chase. For example, after the 2020 crash, Nifty 50 entered a strong markup phase where it rose significantly for many months with improving sentiment. But tell me, do you sometimes get carried away in this excitement and chase the rally? Remember Pring's important warning, trends have different stages. Phase 3 is distribution, the top or autumn phase. Here smart money begins selling while the public is still very excited. Prices may still make new highs, but momentum starts weakening underneath. For example, many traders saw this happen in Nifty 50 during September 2024 and December 2025, where the index was making new highs but momentum indicators started showing negative divergences. Have you ever noticed such negative divergences in your oscillators during market tops? Did it help you become cautious? Phase 4 is Markdown or the downtrend phase like winter. Prices fall as fear spreads across the market. This is the phase where your patience is truly tested the most. For example, in September 2024, Nifty 50 entered a markdown phase and touched lows around 22,000 as fear took over. Have you ever held positions during such a downtrend phase? How did you manage your patience when the market was falling? These 4 phases don't happen in exact fixed time frames, but their sequence is highly reliable when you combine them with volume and momentum tools. Which phase do you think we are in right now? Let me know in the comments below. Let's look at the tools to identify market cycles. Martin Pring strongly emphasizes using momentum and rate of change indicators to confirm where we are in the market cycle. Let me explain a few important ones and how you can use them. First, the Relative Strength Index (RSI). It helps you see if a market is overbought or oversold. In the markup phase, RSI often stays strong above 50. But in the distribution phase, you will frequently notice negative divergences. Price makes new highs while RSI fails to do the same. Have you spotted such divergences on your charts? Next is the MACD, Moving Average Convergence Divergence. This powerful tool shows changes in momentum. Watch how the MACD line and signal line behave across different cycle phases. Crossovers and histogram patterns can give you early clues about shifting momentum. Pring also loved the rate of change (ROC) indicator. It measures how fast prices are moving. A slowing ROC during an uptrend can warn you that the markup phase is maturing and distribution may be near. These tools become extremely useful when you combine them with volume analysis and the overall cycle framework. Let me ask you, which of these indicators do you use regularly in your trading? Have they helped you identify cycle turns in Nifty? Share your experience in the comments. Here are some key ideas from Martin Pring that will help you confirm the different phases of a market cycle. First, focus on momentum oscillators such as RSI and MACD. Always watch for divergences. For example, when price makes a new high but the oscillator fails to confirm it, that is often a warning sign that the current phase is weakening. Second, pay close attention to volume confirmation. In a healthy markup or uptrend phase, you should generally see rising volume supporting the price move. If volume starts drying up while prices are rising, it can be an early red flag. Third, always look at longer time frames. Pring taught us to examine weekly and monthly charts to understand the primary cycle. Daily charts can be noisy, but higher time frames give you the bigger and clearer picture. These simple ideas, when combined together, become very powerful for identifying where we stand in the market cycle. Here is a very practical tip for Indian traders. Combine Martin Pring's cycle awareness with Dow Theory trend confirmation and your simple moving averages. For example, use the 50-day and 200-day moving averages on Nifty 50. When the market is in a markup phase according to Pring, you will usually see price trading comfortably above the 50-day moving average and the 50-day staying above the 200-day. This combination gives you stronger confidence. On the other hand, if Pring's cycle signals distribution but price is still above the moving averages, it acts as a warning to become more cautious. This powerful blend of Pring's cycles, Dow theory and moving averages helps you take better decisions with patience and clarity. Titiksha teaches us the power of patient endurance. In the accumulation phase, when others are filled with fear, you need courage to stay calm. In the distribution phase, when everyone else is greedy, you need discipline to book profits at the right time. Remember these three important things. First, markets always move in cycles. Learn to recognize which phase we are in. Second, use momentum tools like RSI, MACD, and rate of change to confirm your view. Never trade based on emotion alone. Third, cultivate the spirit of Titiksha. Patience is truly your biggest edge in the market. Before we finish, let's quickly talk about a few common mistakes you should avoid. Never chase the tops during the distribution phase when everyone is excited. Never panic and sell at the bottoms during the markdown phase when fear is high. And most importantly, never ignore the bigger cycle picture by only focusing on short-term daily moves. Awareness of these cycles helps you stay disciplined and patient. Friends, understanding Martin Pring's market cycles is a foundational skill for every serious trader and investor. If you found this video valuable, please give it a like and subscribe to Titiksha Finance. This channel is dedicated to bringing you practical technical analysis and powerful mindset lessons. Drop your thoughts in the comments below. Which phase of the cycle do you think we are in right now? What did you like the most in this video? Or if you have any questions related to market cycles, feel free to ask. In the next video, we will dive deeper into one specific momentum tool from Pring. Until then, trade with patience and trade with Titiksha. Thank you so much for watching. See you in the next one.